Hello, viewers. Welcome back to another episode of It's a Learning Curve. Today, again, we have Mr. John Currie, who has helped us with two important topics to make a successful business. It was lean startup methodology and customer acquisition. And today, he is going to illuminate us on the real game, company valuation. Starting up a business, there are stages where we have to raise funds, seed grants, and money from angel investors, venture capitalists, and that is where it is important for us to know what is the value of the company. And today, in this section, Mr. John Currie is going to help us with how to make the company valuation reasonable. That will also keep us protected and safe, and we don't end up giving a lot of stocks and shares of the company to the investors. So, John, please go ahead and start your presentation. We are very excited to learn this.
Sure. Thank you, Trupti. I appreciate being here. Really pleased to have been asked. The big question for today is, what's your company worth? And as you remember, starting up a company is very, very difficult and hard. And so the first week, lean startup methodology gives you some principles to improve your chances of success. And then the second week, the fundamental success factors are all related to customers and how to acquire customers. And so the culmination of when you have achieved customers, fundamentally revenue, that is the major factor and contribution to your company's value. So I thought I'd just walk you through some principles of how to think about valuation in its most basic forms, and feel free to ask any questions.
Absolutely.
Let me share screen. Okay, let's see. Can you see my screen?
Not yet.
Not yet? Okay, let's see, share. Okay, there we go.
Perfect.
Can you see it? Good. Okay, great. So let me turn on slideshow. And the fundamental principle about valuation, what your company's worth, it really is tied to this buzzword called traction. And traction needs to be defined. So let's define key milestones, and these milestones are pretty well known both in the world of founders and entrepreneurs and the world of investors. When you start a company, usually you have a concept and you're pre-revenue, and you do something to communicate. It's called a mock-up. And this could be a brochure, but you spend a few months working on your vision, your concept, and you start talking to customers about it. And that's what you use, a mock-up. After you talk to enough customers, you find out what they will buy and start spending money. That's what's called the minimal viable product. This is where you need to be taking some element of money and what the first instance or first product looks like that you can actually sell. And that's what the MVP is. We talked about that at Lean Startups, the minimal viable product. And then after you talk to even more customers and really start refining, you do enough of them, what's called pilots. You now have enough customers out there that your first version of product starts to become cemented and specific and repeatable, and because you have enough customers playing with it now, and it becomes frozen, and your business model starts to become clear. And so then you're ready to move on to a truly repeatable sales process. And CAC is the cost of acquiring customers. This is where you've found where your customers hang out. You know how to reach them. You know exactly how much it costs to get them and to attract them. So you start to take a lot more orders, and you're on your way to what's the holy grail of product market fit. This is where your product is flying off the shelf. And from there, you're in a great position to really grow. And you can grow by more products, you can grow by more markets, you can grow by more geographies. So growth. So this is the way to think about how you build your company over a period of, could be months, it could be years. That's probably one of the toughest things, that each of these stages, could be as short as a couple of months or as long as a couple of years for each. So let's continue with this definition of traction. The key metric, the key milestone, you must put revenue as the key metric. So this is all about customers and the amount of money they are willing to pay. MRR is monthly recurring revenue. And these are the general guidelines that investors use. And this is for any type of company. And so you can see from a pre-revenue company where your concept and your vision, you have zero, it's pre-revenue. And then as you start taking more money, you look at it on a monthly basis, because month 1 of the year should be a lot different than month 10. So it really is, you want to be in the growth trajectory, and you're building on these revenue metrics. And you can also think about it as, let's take the pilot phase where you're doing $10,000 a month. You could also look at that and say, I have one customer doing $100,000 a year, or I have 10 customers doing $10,000 one a month, or I have 100 customers doing $100 each. So that is the way to think about it. Things do translate into these kinds of revenues. And so now, what is it that think about from the entrepreneur's perspective? You're the founder and you say, I'm having some success and I need to go to the next level. Well, that next level is going to take some money. So I think I'm willing to sell about 30%. Sometimes it might be 25, sometimes it might be 40, but it's usually a reasonable amount. The guideline is you'll sell 30% of your startup to investors to get to the next stage in your journey. That's really how to think about it. So if you use that formula, let's talk about what that investment round would look like. So these rounds at the end of these periods, when you're ready to move on, you have very specific periods to say, okay, I'm ready. I'm looking at a pre-seed round. I don't have any revenue, but I have a lot of interest from customers who are talking to me. So what do I want to go raise? So let's put some numbers down. These are general guideline numbers. If you're in the pre-revenue, pre-seed round, you're going to look at a very small amount of money from angels or family and friends. If you're in the seed round where you're actually having money thrown at you, you might be looking at $2 million. If you're in a Series A, it's 4 to 6, Series B, and you can see these. And you can do the math if you say, okay, in general, I'm at the MVP stage, I'm raising 2 million. I probably have a company worth $5 or $6 million. That is really how to think about it. If I'm going for a Series A and I'm at this stage, I think I've found the customers and I really want to hit this growth. You could argue that my company is worth $10 to $25 million. So it's a wide range. And so I thought what would be a very good way to think about this, let's map on a graph these numbers. So let's take our x-axis as your milestones, the traction milestones, and map valuation. So we can kind of study this a little bit better picture of what's the valuation and how to think about your company. So we mentioned, okay, on the mock-up pre-seed, we want to raise money to get to the MVP stage. We're looking at the company's value around $2 or $3 million. So it fits there with a small amount of variability. The next round is seed, and that is where we might be going for 1 to 3 million, and the valuation is in the 4 to 6. The next one is a Series A, where we're going to hit growth, and that one you can see where that fits. The variability is much higher, but now look at the new trajectory: a Series A, a Series B, and a Series C. And so what you see here is there's essentially two risk slopes. There's a very high risk period where the valuation is not, this is where it's a very risky, a lot of investors don't like the super early stages because of all the risk. And then you can see once you start hitting the customer equation, you go into a different slope. And that's where a lot of investors want to jump in. And I thought what we might also talk about is you can start to look at this graph, and there's a number of drivers. You can see, well, what about a chart? There's instances that would drive your valuation to look like that, and other instances that would drive it to look like that. So let's talk about some of these factors. One of them, are you in Silicon Valley or not? That is a very real thing. If you are in Silicon Valley, you are probably going to have a higher, it's going to be above the curve, above the line.
Awesome.
Whereas if you're outside of Silicon Valley, you're going to be under. You're not going to get the valuation. And it's a very real thing. Another driver that investors look at, do the executives, have they been in previous startups? And have they gone through this journey before? If they have, they're probably going to be rewarded with higher valuations because they've been through it before. Whereas if they're not, and this is another, there are not very diverse in the entrepreneurial and VC world. There are not many female founders, and there are not many minority founders, and they're not rewarded. So they typically will get valuations below the line. And another thing that gets asked is, what about intellectual property? Where does intellectual property? So this is always subjective, because it's how valuable is your intellectual property. And so valuable intellectual property can get a bump in your valuation. But that's also highly debated sometimes. And conversely, if you're in certain sectors, like if you make consumer products, if you are in manufacturing that takes a lot of capital equipment, consumer products require things like inventory and usually very high cost of acquiring customers. Investors shy away from those kind of companies, where compared to software that doesn't have much of a cost. And so if you're in the software business, you should have much higher profit and a lot more investors looking at those kind of investments. So essentially, there's the principles, the basic principles. And I invite you to ask questions. I also want to give credits to Erica Dagnan-Minahan. Has this video, which I borrowed some of these principles. She explains it over a 45-minute video, but I found some of the charts to be very helpful in putting this together. So I borrowed some of them. I want to give her some credit for this, for the source of some of this.
Cool. So I definitely had one important question. So during the first seed round, Series A, or just the seed round, I would say, the company is still not making revenue, but investors have come ahead and invested in the company. After taking the investment also, is there any time limit where the company has to start making revenue, or the investors can get back to us? Are there any kind of such limitations? Are there any kind of terms those are involved in such kind of things?
Good question. So this really does get back to the the fundamental order of things, which says raise customers before you raise investment. Because the theory around taking a seed round says that you've graduated there's from tiny amounts of money. There are enough customers throwing small amounts of money that you could take this seed round and win a lot of these customers that you know. And so when you take money, you are absolutely you are put on this, you are committed to returning their investment in a period of time.
Right.
Right. And so the expectation is we're going to take this money, whether it's whatever round, and it's going to give us runway of perhaps a year. And
Okay.
then at the end of the year, number one, we'll be out of money and we will have hit the metrics that we promise to be for the next phase. And
Perfect.
so in an ideal world, we take the money, we get onto this new trajectory, and then everything's running well, and we're going to go out for a Series A and raise this much more money, another couple of $1 million, so we can continue on this trajectory.
Perfect. So what I'm understanding is it is better to have the customers in place, rather have a letter of intent or POs from the customer before raising any kind of funds.
Right.
Yeah.
Because fundamentally, investors are paying for your repeatable sales process.
Perfect.
They want to put money in. You are showing them a black box saying, I can churn, customers come in and pay me this much money. And if you give me more money, I can get a lot more customers.
Terrific.
That's what they want to fund. And that's what represents this slope. On this first slope, you're figuring all that out.
Yeah.
And
Okay.
why there's not as much money, and it's a lot harder to figure that out. Once you have figured it out, you go on a different slope usually.
Got it.
And it could even be, you could argue this is a parabolic curve as well. Ideally,
Yeah. John, can I request you to stop sharing so that I can talk further and people can see us?
Absolutely.
Yeah. So one more question, which was not related to the charts, but I had in my mind was, how do we protect our assets before we are giving the shares of our company to any investors? And second relatable question would be, if I end up giving 51% of the stocks to investors or other people in the company, am I still going to be the owner of the company?
So those are two really good questions. And so understanding, this is why these metrics are so important, and really understanding the rounds from all of the stages from pre-seed up through growth. Because if you sell too much too early, it's not going to end well. And if it takes too long, so there's an ideal path. So how to protect is where you think about, if you're ready to sell, usually it's about 30%. And that equation usually keeps the founders in control. Now, if you sell 51%, the question, who's in charge, it's still a different question. So you can still be the majority shareholder, owning, let's just say, 35% of the company.
Yeah.
And the question, it's who are the other shareholders,
Right.
and what are their amounts, right? And that actually is a different question, but related to who calls the shots.
Right.
So there's operational shots, and what usually the board or the governance of the company is meant to manage the shares. So when the company forms, they decide on their equity, their shares. Preferred shares usually go to investors, which means it's a term. They get preferred treatment as opposed to common. Common shares are behind preferred. And so I guess I'm rambling, and that it's not so much the 51%. It's about operational control and majority. Majority. Who are the shareholders, and how much do they have? So, you know what I'm saying? If there's 5 shareholders,
Yes.
one has 30, 10, 10, 10.
Right.
So when you start to do that, it's the majority, and how are votes decided? Usually votes are decided not by shares, but by there's 5 members on the board, and they each have 1 vote.
Okay, got it.
So board formation becomes important. So these are a lot of little
tidbits to learn.
tricks. Yeah, to maintain. You do definitely want to maintain control. And if you sell too much of the company too early, usually you get what happens is the incentives aren't there. And so the team has to be incentivized usually with equity to work as hard as it takes.
Right. Okay, so with that, I would like to thank you a lot for helping us with all these different concepts in a startup business and simplifying it in so much that anybody can really sit down and learn and understand it in a very, very easy manner. So, John, again, thank you very much for your precious time. And audience, thank you for following my channel and my shows. And I would like you to keep watching such useful and informational videos on my channel, and please subscribe to my channel for more such videos. Thank you very much. Thank you, John.
Thank you, Trupti. And feel free, I'll send you the slides so you can distribute them to anyone.
Thank you.
Thank you. Bye-bye.
Bye.